This is Matthew Krater's Bitcoin University. Today I want to talk about a very, very important topic. This is what I'm calling a Bitcoin year-end tax emergency. We're going to be talking about the IRS safe harbor rule, and this is something that just came on my radar a couple of days ago, and I finally had a chance to take a look into it. This is extremely, extremely important to take care of before December 31st, 2024 this year. And what follows is obviously not tax advice. I'm not a tax advisor or tax professional. It's not legal advice. It's not financial advice. This video is going to be a little bit boring and painful, but I really encourage you to watch the whole thing and take action before the end of the year. And what we're going to be talking about, this mainly concerns U.S. taxpayers. We're going to be talking about IRS Revenue Procedure 2024-28, which is this 24-page document that I will link to in the description notes below. First, some tax terminology to bring everyone up to speed. Cost basis, what is this? It's just the total value paid plus any associated fees or broker commissions. For example, when you buy a stock. Gross proceeds, the total amount received from the sale of the asset minus any associated fees. And the way you calculate a capital gain or gains is you say gross proceeds minus cost basis. To give you a concrete example, let's say you bought 1,000 shares of stock XYZ at $100 a share. You paid a $10 commission for this. It's sort of like the old days paying commissions. In this case, your cost basis would be what you paid for those shares, so $100,000, 1,000 shares at 100 plus the commission. And then when you sell that, you would say you sold 1,000 shares of XYZ, let's say at $150 per share. You paid another $10 commission. Your gross proceeds are what you receive minus the commission, so $149,990. And the way you calculate your cap gains is just gross proceeds minus cost basis. And then if the asset was held for more than 1 year, it's a long-term cap gain. If the asset was held for a year or less, it's a short-term cap gain. You have these various long-term cap gains rates depending on your income, 0% for some people, then up to 15, 20%. Plus, if you're above a certain amount, there's the NIIT, the net investment income tax of 3.8%. So in the U.S., the max long-term cap gains rate, not counting individual state taxes, is roughly 23.8. So that's the long-term cap gains rates. Short-term cap gains rates taxed at the same rates as ordinary income. If you've ever done any trading or investing and then filled out your tax return for the following year, you'll understand some of this, but I just want everyone to understand what cost basis is, because that's going to be very important. Now, how you calculate your cap gains can have a massive effect on how much in taxes you're going to pay that year, and the goal is obviously always to defer taxes as long as possible. At the end of the day, you're probably going to end up paying the same amount in taxes unless there's some tax cuts in the future, but the idea here is you want to pay as little taxes as possible. And again, we're talking about tax avoidance here, doing legal things. We're not talking about tax evasion, which is highly illegal. But the goal is to always defer your taxes as long as possible, and that way you have the use of the money and you can keep investing it, etc. So let's say you bought 2 lots of XYZ. This is where calculating the cost basis can have a big effect on how much you pay in taxes. So let's say you bought 2 chunks. You bought 1,000 shares of XYZ at 100. Then you bought 1,000 shares of XYZ on a different day at 150. Now let's say a few weeks or months later, you sell 1,000 shares of XYZ at 200. There are different ways of calculating your capital gains on this transaction. If you use what's called FIFO accounting, which is first in, first out, for the purposes of calculating cap gains, you would use the lot that you purchased first. In this case, it would be that 1,000 shares of XYZ bought at 100, and then you were saying that you sold it at 200. That would be a $100,000 cap gain that you'd have to apply the capital gains tax rates to. So that's a much higher cap gain, 100,000 cap gain. If we look at it under LIFO accounting, which is last in, first out, in that case, you would use as your cost basis, you would use the 1,000 shares of XYZ that you bought at 150, sold at 200. In that case, your capital gains would only be 50,000. So it would basically be half. If you use LIFO, your taxes this year would be half of what they would be if you used FIFO, or at least your capital gains would be half of what it would be if you used FIFO. So traditionally, in traditional TradFi investing, when you buy and sell stocks at the end of the year, the next year you'll get a 1099, which shows your gross proceeds, and it usually shows your cost basis as well. And this is provided both to you and to the IRS, and the game is you're supposed to match this stuff on your tax return. At least this is how it works in the US. And it's fairly simple when it comes to stocks because you're probably going to be buying and selling the same stock in the same account. Maybe you move it from one account to another, but it's fairly easy to keep track of your cost basis. It's a little bit more difficult when it comes to Bitcoin and crypto, where you can be holding them in many different places. So let's say, for example, you have some Bitcoin that you've left on Coinbase. Coinbase is obviously a custodial wallet. They're holding your keys for you. This is what the IRS and some governments call a hosted wallet. This is absurd terminology. This is typical Orwellian newspeak. But basically what it means is someone else is holding your private keys. This is a completely made up term. There's no such thing as hosting, etc. What you basically have is cryptographic keys. But for the sake of using the IRS's terminology, let's say you have a hosted wallet at Coinbase, a hosted wallet at River, and then you have two unhosted or self-hosted wallets. That's the terminology they use, which is absurd. But let's say you have some Bitcoin on hardware wallet number 1 that you originally bought on Coinbase and then withdrew to that hardware wallet. Then let's say you also have hardware wallet number 2. These have different seed phrases, so they're considered different wallets, and all the Bitcoin public keys and private keys that are derived from them are derived from that master seed. In this case, you have 2 of them. You have hardware wallet number 1, hardware wallet number 2. Hardware wallet number 2 is also an unhosted wallet. It's the Bitcoin that you originally bought on River and withdrew. So you have 2 custodial wallets, 2 hosted wallets here, and 2 self-custodial wallets or unhosted wallets. Now, before we go on, I just ask you, if you're finding this video helpful so far, please help to support this channel's educational mission. Hit the subscribe button, leave a like, leave a comment, question, suggestion for a future video. Share this video with a friend or family member. Now, under the old IRS tax reporting method, when you sold or spent Bitcoin or crypto, you could pick whichever wallet you wanted from which to pick a chunk of Bitcoin for your cost basis. This was what was called universal or multi-wallet, the multi-wallet method of accounting. And this method views all of your Bitcoin and crypto holdings as residing in one giant bucket, and you're then able to pick whichever lots you want to allocate your cost basis when you're reporting your capital gains on your tax return. Now, beginning in 2025, U.S. taxpayers are going to need to move to a wallet-by-wallet method of accounting. And so the opportunity right now, that is before December 31st, 2024, is to document your current holdings and cost basis on a wallet-by-wallet basis, because you're no longer going to be able to use this universal wallet method of accounting. You're going to have to document your holdings of Bitcoin and the cost basis for those holdings on a wallet-by-wallet basis. And then you're also going to have to tell the IRS how you're going to be accounting for cost basis and capital gains going forward. And so what safe harbor means in this context, this is the IRS saying basically we've been a little bit unclear over the past decade or so, but now starting in 2025, all the crypto brokers, all the Bitcoin exchanges are going to need to report your cost basis in addition to the gross proceeds to the IRS. And this new method of accounting is going to go into effect. And so you have this opportunity to bring your own tax compliance into the safe harbor, the IRS giving you one last chance to protect yourself from future penalties if you take the following steps. And I admit these following steps are absolutely absurd. They're an incredible invasion of privacy. And the fact that this is all being put upon us, there hasn't been a lot of publicity surrounding this, though I think this revenue document came out in the summer. But this is sort of a last minute thing, and it's a complete mess, and I guarantee it's going to ruin your weekend as much as it's ruining mine. But basically, this is something that it makes sense, I think, to do. Again, that's not tax advice, but I think you should try to bring yourself into this safe harbor if possible. And again, safe harbor just means this is the IRS giving you one last chance to protect yourself from future penalties if you put together the following documentation before December 31st, 2024, and you timestamp it. You need to be able to prove to the IRS that you did this before the end of the year in 2024. First step, consolidate your wallets if possible. This is more just to make this job easier for you. It's much better to have 5 Bitcoin wallets than 50 Bitcoin wallets, especially for your large holdings. Unfortunately, consolidation, combining wallets, combining Bitcoin addresses can lead to privacy leaks, where common ownership of UTXOs, chunks of Bitcoin, is assumed if they're merged. In other words, if they're sent together as inputs to a Bitcoin transaction. So there are trade-offs here. That itself, as always in Bitcoin, is another very, very deep rabbit hole. I have this playlist on UTXO management which is probably not something you want to watch this weekend, but that talks about the privacy risks to consolidating Bitcoin addresses and inputs. So that would be number one, sort of simplify your holdings. Number two, take a snapshot of holdings in each wallet before the end of the day on December 31st. You can do this right now. You can do this today, for example, as I'm recording this on Saturday, but only if you're done buying, selling, trading for 2024. And then, of course, consider the privacy issues if this snapshot is uploaded to the cloud or stored anywhere online. So if you just take a picture of your holdings with your phone or a screenshot, you have to consider where those are going to be uploaded to the cloud. And again, this is just another horrible privacy violation, and this is one reason why the income tax should be unconstitutional, because it's a huge violation of personal privacy. So that's number two. Number one, consolidate your wallets. Number two, take a snapshot of your holdings, and then print out and sign and date a form like this after having read it. I'm going to give you two examples. I've yet to dig pretty deep into these, but basically you attest to certain things and then you sign and date it. And there are two versions of this. And you can see the purpose. This document records my intention to transition my digital assets from a universal or multi-wallet method of accounting, which is what we just talked about, to a wallet-by-wallet method of accounting in accordance with a certain revenue procedure. This document records my plan to make an irrevocable and reasonable allocation of units of unused basis of cryptocurrency to avail myself of the safe harbor. So you can take a look at both of these documents. They both look good to me, but again, I'm not a tax guy. And then if you need to attach a timestamp, you can use opentimestamps.org, where you can upload whatever you need to timestamp right here, and it will provide verification. And you can see the directions here. I still have to figure out how to do this myself. I wish I could include it in this video, but they do explain how to do it on this website. You could also just email these documents to yourself. The problem with that as a timestamp method is obviously if anyone ever reads your email, if your email is ever hacked, they'll be able to see this. And of course, when you send an email, it is all vacuumed up by the NSA and all the intel agencies globally as well. So that's a problem with using email as a timestamp. Very, very important. And one thing to consider whether you're deciding to do this or not, you do not need to send this information to the IRS now. This is for your personal documentation to be provided in the future to the IRS, perhaps if you're audited or you need to otherwise prove how you are allocating your cost basis and whether you're in this safe harbor. Now, hopefully Trump will reduce or completely eliminate the capital gains tax on Bitcoin. It's absurd to have a capital gains tax on money. For example, when I spend US dollars, there's no capital gains tax on it. And so this should definitely happen. And if that happens, if Trump were to eliminate the cap gains tax on Bitcoin, this would render capital gains calculations like this irrelevant. So you may never need this documentation. I'm pretty skeptical, though, that the U.S. government's can do this and remove cap gains taxes on Bitcoin anytime soon. And so I think it may make sense to prepare this information. Hopefully, in best case scenario, you'll never need to share this private information in the future with the IRS or anyone else. But I think it's good to have, and it's good to bring yourself into compliance if this is something you're worried about. And you can think of it this way: if you just get your documentation together, this gives you some optionality going forward to the extent that the government becomes more hostile in terms of taxing Bitcoin. Now, what happens if you ignore this video and you do nothing? The problem is you're still going to have to calculate your cost basis in the future. You're going to have to do this work in the future anyway if you ever send or spend your Bitcoin in the US. If you spend your Bitcoin on goods and services, it's deemed a sale and you have to pay capital gains taxes as well. This is yet another thing that needs to be revoked by Trump. But basically, you can choose to do this weekend and bring yourself within the safe harbor. And if you don't do that, you're still going to have to do this in the future. You're still going to have to calculate your cost basis. And if you haven't brought yourself into safe harbor by signing and documenting that form, you may end up being stuck with the FIFO method of accounting in the future. In other words, you'll end up probably paying more taxes whenever you next sell or spend, assuming that Bitcoin continues to rise, which is what I expect. So I would really spend the time this weekend getting your tax accounting house in order if you can. Again, this is a huge privacy mess. Consider this as you're documenting your holdings. We talked about this a moment ago, possibly uploading them to the cloud or sending them to yourself in emails. That can be a very bad privacy idea. And again, I want to go out be on the record saying, I believe taxation is theft. and I am against this. Nevertheless, I do comply with it, and you'll see the reasons why. There are going to be people in the comments saying that you should not pay your taxes because you're technically not required to under various interpretations of tax law going back to the original 1913 constitutional amendment. However, tax evasion is extremely, extremely serious. You should not do it. You will be caught eventually, and you could end up spending years in jail, as happened to this Texas man who's spending 2 years in jail for cheating and cheating on how he reported his $3.7 million in sales of Bitcoin. And then we have Roger Ver, who I believe is still sitting in a jail in Spain awaiting extradition, and he's been charged with tax evasion as well for allegedly hiding, not reporting some of his Bitcoin when he left the US and did the exit tax. So it might take the IRS 2, 5, 10 years to track you down, but they will eventually track you down. So I encourage you to not do tax evasion. You could say, there could be people saying in the comments, oh, you just tell the IRS you lost your Bitcoin in a boating accident. This, unfortunately, it's a great meme, but it's not going to work as an excuse if that chunk of Bitcoin, if that UTXO ever moves on the blockchain again. So don't do that. If you tell the IRS you lost your private keys to your Bitcoin and no longer have access to it and thus don't owe taxes, you can never move that Bitcoin again, or at least as long as the IRS is around, or as long as you don't want to be captured and put in jail by the IRS. I'm going to link to a number of resources here. This is an Andreas Antonopoulos video that's quite long, an hour and 40 minutes, talking about safe harbor. And this is the guy he's interviewing. I'll put a link to this. Also, Laura Walter here had, I thought, a quite good video about this safe harbor thing, as well as her blog post on it. And then I'll link to a couple other proof of money, had a couple interesting posts on X about it. So I'm going to link to all this material so you can work through it as I've been working through it. Also, Andrew Gordon had a very good short video here that I think is a good summary. This is a Bitcoin only channel, but obviously these IRS tax rules apply to all digital assets, not just Bitcoin, but all the crypto garbage you're holding, all the NFT garbage you're holding, all the crypto you're staking, all the crypto you have in DeFi, etc. If you've been staking or using DeFi, heaven help you doing this accounting. It's going to be a complete mess because the regulations aren't clear at all, and you probably have a lot of moving parts to keep track of. If you've been trading crypto garbage, heaven help you as well. This process is actually going to be easier for and easiest for Bitcoin hodlers who buy and try to never sell, and thus have fewer transactions and fewer wallets and accounts. My personal goal, of course, is to out-hodl the IRS. I like to wait to spend any Bitcoin until there are no more cap gains taxes on Bitcoin, and this may or may not be possible, but I think for now it makes sense to get this documentation into order, so at least you have the optionality going forward. I've got to get to work doing it this weekend, so next video, Monday, possibly even Tuesday. I'm going to be doing some traveling as well, so we'll see how this all plays out. So I'm very sorry to give you a video like this and ruin your weekend. This topic's definitely been ruining my last couple days, but I encourage you to work through this, and even if you can't do it perfectly, I think any good attempt will be appreciated by the IRS, and they'll give you the benefit of the doubt if you've at least tried. If you enjoyed this video, be sure to hit the subscribe and like buttons, hit the notification bell if you want to be notified when I publish my next video, and let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.